Disclaimer. Look at your savings for a moment. Not just the number on the screen, but what that number actually represents. Hours of your life, years of effort, deferred pleasures, security you were promised would still be there later. Now consider this uncomfortable thought. What if that number isn't disappearing because you were doing something wrong, but because the system itself is designed to slowly reduce its real value? Right now, the United States carries a national debt measured in tens of trillions of dollars. The number is so large it no longer feels real. It scrolls past on news tickers, flashes on digital clocks, and gets dismissed as background noise. For years, the public was told not to worry. That debt didn't matter. It was manageable. It was owed to ourselves. But something shifted recently, quietly, structurally, in a way that doesn't require announcements or emergency speeches. For the first time, interest payments on federal debt have grown large enough to rival, and in some projections exceed, entire categories of government spending that once seemed untouchable. This isn't a theoretical concern anymore. It's arithmetic pressing against political reality. When households face too much debt, they tighten their belts. They cut expenses. They renegotiate. Governments don't function that way. Much of federal spending is locked in by law or political necessity. Retirement programs, healthcare commitments, defense obligations, these aren't line items that can be casually erased without consequences. So when interest costs rise faster than revenue, governments face a constrained set of options. Economists have debated these options for generations, and the conclusions are remarkably consistent. In broad terms, there are only a few ways heavily indebted nations reduce debt burdens. They can dramatically cut spending and raise taxes at the same time. They can refuse to pay, damaging their credibility. Or they can allow inflation to reduce the real value of what they owe over time. The first option sounds responsible in theory. In practice, it requires political decisions so severe they are rarely sustained in large, complex democracies. Sharp tax increases and deep spending cuts tend to slow economic activity, increase unemployment, and trigger voter backlash. History shows that governments that push austerity too far often reverse course under pressure. The second option, outright default, is even more disruptive. For a country whose financial instruments are deeply woven into the global system, refusing to honor obligations would ripple far beyond its own borders. Confidence, once broken, is difficult to restore. That leaves the third path. Not dramatic, not sudden, but historically common. Managing debt through inflation. Inflation doesn't require announcing failure. It doesn't cancel obligations. It simply changes what those obligations are worth in real terms. When prices rise steadily over many years, debts contracted in the past become easier to service using future dollars that buy less than before. This isn't a theory hidden on the fringes of economics. It's documented history. After World War II, many advanced economies carried debt loads far larger relative to their economies than today. They didn't pay them off through budget surpluses alone. They allowed growth and inflation to do much of the work quietly. The people who felt this most weren't governments. They were savers, bondholders, workers whose wages adjusted slowly while prices moved faster. That's the critical distinction. Inflation doesn't destroy numbers. It reshapes purchasing power. The balance sheet may look stable, but daily life becomes more expensive. When inflation runs modestly above interest rates, debt shrinks relative to income, but savings shrink too. This is why inflation is often described as a hidden tax. No vote, no bill, no single moment where people realize what's happening, just gradual erosion. To make this approach workable, several conditions tend to appear together. Interest rates must be managed carefully so debt servicing remains affordable. Large institutional buyers must continue purchasing government debt. And inflation metrics must remain within ranges that feel tolerable, even if lived experience feels tighter. Over the last decade, global central banks have played a much larger role in bond markets than in previous eras. Asset purchases, balance sheet expansions, and policy coordination became normalized responses to crisis. These tools were initially described as temporary. Many are now semi-permanent features of the system. Meanwhile, traditional large foreign buyers of U.S. debt have slowed or stabilized their holdings. That doesn't mean demand disappears. It shifts. Domestic institutions, regulated banks, pension funds, and central banks fill the gap, often because regulations encourage or require them to hold government securities. This creates a system where demand for government debt remains strong even when returns are low. From a stability perspective, this keeps borrowing costs manageable. From a saver's perspective, it often means returns that fail to keep up with rising costs of living. Inflation measurement plays a role here as well. Price indices are complex statistical tools. They evolve over time. Methodologies change to reflect consumption patterns, substitutions, and technological improvements. These adjustments are not inherently deceptive, but they do mean that official inflation figures may not always match individual experiences, especially for essentials like housing, healthcare, and education. If inflation appears contained on paper, pressure to raise interest rates aggressively is reduced. That keeps borrowing affordable for governments, but extends the period during which savers earn less than inflation. This environment produces uneven outcomes. Those who own assets that adjust with inflation, real estate, equities, businesses, often see values rise. Those who rely primarily on fixed income or cash savings feel squeezed. This divergence isn't accidental. It's a recurring feature of inflationary periods. Economists have observed it for centuries. New money and credit enter the economy unevenly, benefiting those closest to financial channels first. By the time effects reach wages, prices have already moved. The result is a widening gap between asset holders and wage earners. Not because of individual failure, but because of structural incentives built into monetary systems under stress. As debt grows large relative to economic output, governments tend to prioritize stability over purity. Avoiding crisis becomes the primary objective. Gradual inflation, managed carefully, becomes a tool rather than a flaw. This is why many analysts argue that the real question is not whether inflation will play a role in managing debt, but how long it can be sustained without triggering loss of confidence. And that's where part 2 begins. Confidence is the invisible glue of the modern financial system. It isn't law or metal. It exists in collective belief. As long as people trust money will hold value tomorrow, payments clear, loans roll over, and markets remain calm. When that belief falters, behavior shifts faster than policy can react. That's why confidence matters more than fundamentals in the short term. High debt or structural weakness can persist as long as trust endures. Once trust cracks, even seemingly stable systems strain. This is also why inflation is never meant to feel dramatic. Policymakers aim for discomfort, not panic. Prices rise just enough to be blamed on supply chains, energy, geopolitics, or corporate decisions. Inflation is framed as temporary, never deliberate. Once it's recognized as intentional, trust erodes. As trust fades, predictable behavior vanishes, savings decline, long-term bonds are abandoned, money moves faster, spending accelerates, risk-taking increases, capital searches for shelter. Controlling this behavior is difficult. Debt-driven inflation must be gradual. Slow inflation feels manageable. Fast inflation threatens. At 4 to 5% yearly, most adapt. Over a decade, erosion becomes clear. Savings lose power, long-term plans shrink, retirement math fails. Yet because change is slow, reactions are delayed. Governments know this. Sudden change sparks resistance. Gradual change becomes normal. Traditional saving no longer works. Bank interest struggles to outpace rising costs. Government bonds offer stability, but not preservation. What once felt safe quietly leaks value. Behavior shifts. People move into assets not out of greed, but necessity. The system turns everyone into reluctant investors. This is no accident. It's incentive-driven. Low interest rates ease debt for governments, borrowers, and asset owners, but savers fall behind. Savers are often wage earners or retirees, reshaping society. Those with appreciating assets gain wealth, property markets and prices rise. Wages lag. Essentials rise faster. The result is divergence between upstream and downstream participants in the financial system. New money flows through financial channels first. Institutions near credit creation benefit before prices adjust. Asset inflation precedes consumer inflation. Markets climb. Real estate rises. Headlines celebrate prosperity. Only later do rents, food, healthcare, and insurance catch up, by which time redistribution has occurred. Regulation reinforces this. Banks, pensions, and insurers are encouraged to hold government debt, guaranteeing demand regardless of yield. From a system view, this is stability. From an individual view, it limits choice. Savers believe money is protected, yet much of it quietly supports the system through foregone returns and inflation. Inflation measures maintain this balance. Official statistics are averages. Lived experience often differs. Housing, healthcare, education, and insurance rise faster than headline numbers. Containment eases pressure to raise rates, benefiting borrowers while leaving savers behind. Central banks know this trade-off. Raising rates risks growth. Keeping them low erodes purchasing power. Recently, accommodation has often prevailed. Markets adapted. Investors expect intervention. Risk is repriced. Volatility low until it isn't. Confidence in backstops becomes part of the system. Global shifts further tighten internal loops. Foreign holders reduce exposure. Domestic institutions fill gaps. Internal dependence makes confidence even more critical. Technology accelerates this. Digital money adds speed, efficiency, and traceability. Policy tools gain precision. Supporters see efficiency. Critics see control. Both are true. Once established, these tools rarely vanish. History shows financial stress expands authority. Emergency measures become permanent. Rules shift mid-cycle. Stability prioritized over purity. This doesn't guarantee collapse. It guarantees flexibility. Intervention tools exist. Their use depends on pressure, not intent. Understanding incentives matters more than predicting outcomes. Debt creates pressure. Inflation relieves it unevenly. For individuals, the message isn't panic, but awareness. Saving is no longer passive. Nominal safety rarely preserves real value. Adaptable strategies outperform rigid ones. Productive assets and skills adjust faster than static currency. Risk exists even where safety is assumed. Large debts aren't erased overnight. They're managed via growth, restructuring, and inflation. Effects accumulate subtly. Delayed goals, thinner margins, longer working lives, quietly lowered expectations. Loss isn't immediate. Delay is. People react too late once confidence visibly cracks. Understanding the system early allows navigation, not escape. Debt isn't disappearing. It's reshaped over time. The cost is distributed quietly. Those who grasp the mechanics are better positioned. The real question isn't whether this process exists. It's whether you recognize it while adaptation is still possible. Understanding money isn't about predicting collapse. It's about seeing change before it becomes unavoidable. If this helped you understand the system, make sure to like this video, subscribe to the channel, and hit the notification bell so you don't miss future insights.